Right, we're at the NDTV Profit Conclave, and I have with me the man of the moment who's still extremely bullish with regard to Indian markets. We have Ridham Desai of Morgan Stanley, needs no introduction. I'm going to start off, Ridham, because as part of the conclave conversation, you suggested that the GDP growth concerns are now firmly behind us, in your opinion. What's giving you that confidence?
So I think there have been a fair bit of policy actions that have taken place. The spending slowdown that we saw from the government in the first half of this fiscal is behind us. The RBI has pivoted. The budget, I think, has set the stage for accelerated growth. And the globe doesn't look as murky as it may have been 3 months ago. So I think the stage is set. Obviously, the signals are not there. By the time the signals come, stocks won't be at these levels. But I am fairly confident the signals will come our way in the next few weeks.
There's a call, and there's one large CIO who suggested that there is real reason to worry because of overvaluation. Now, when I'm analyzing the 5-year average price to earnings multiples of SMID stocks, and this is just the benchmark, it's trading at a 30 to 40% premium even now, despite the fall. Generally, fundamentals suggest that in case of overvaluation, generally markets correct. What's your sense now, and what keeps you bullish at this hour?
There were certainly some places where a bit of frothiness had come through. And I think this correction has evened that frothiness out. I hesitate to use a P multiple to measure value. Value is really about future cash flows, not about price divided by earnings. But as I said at the conclave, if you look at the Sensex, in gold ounces, it's trading at November 20 levels, which does make it look a lot more interesting from a valuation perspective than it was a few months ago. There could still be some areas in the market that are a little bit overvalued, but I think many parts of the market now look very interesting. For example, financial stocks look very attractive. Select consumer names look very attractive. The IT names look very attractive. I think some industrial names have corrected very sharply and have now again begun to look attractive. So there are many places in the market, and I think this is not the macro market that we were getting used to. It's more a stock pickers market. So there are enough opportunities for investors to participate in the market.
The one major concern for the average retail investor has been the FI selling. One of the reasons possibly is the fact that bond yields have been at 4.5% for a prolonged period of time, and doesn't seem like a rate cut, at least in the US, is on the cards in a significant fashion. Now, when US returns are at 4.5% and you have currency depreciation factoring 7.5% risk-free, why would a foreign investor invest in India?
So I don't think there's that much concern as we are making it out to be. Otherwise, there wouldn't be a domestic bid like we have seen so far. So domestic investors clearly understand this market a whole lot better than foreign investors. Foreign investors, of course, have competing asset classes. And you brought US metrics into this conversation, but I think we may have basically been outcompeted by China rather than by the US. And China did some policy changes, and it does look like the Trump administration is not as belligerent as the markets may have been thinking. And that has given legs to the Chinese rally. Foreign flows, I think, will come at a time when corporate issuances rise, because I really don't see the retail bid going away on a prolonged basis. There may be a few days here and there where the retail bid goes away, but otherwise, if retail investors, and I mean retail plus domestic institutional investors, are bidding every single day, there is no room for foreigners to buy unless corporate issuances resume.
So yeah, I'll just extend that question a little bit more. So corporate issuances have been coming through the pipeline, they have been coming through the door. But when you're looking again at relative valuations, India versus EM and global, India is trading at a significant premium. For example, a Whirlpool, for example, an LG coming, for example, a Hyundai coming up. I'm just giving you illustrative names. Is that at all in some form a sign that Indian markets are overly buoyant, or you wouldn't be concerned about it?
See, first of all, no single participant in the market is smart enough to know the future. So just because one cohort is selling and another cohort is not participating doesn't mean that that cohort understands future better than the other cohort. That's one point. Second is with respect to the comparison you made with emerging markets. See, ultimately, what equities care for is whether you can deliver a return on capital that is greater than your cost of capital and whether you can deliver a growth rate that is greater than your cost of capital. And on these two metrics, there are very few equity markets. I dare say only two markets in the world that have a tick mark, which is America and India. So I think India's premium valuations versus EM are very justified. Much better balance sheets, much better growth rate, much better return on capital.
Thank you, Ridham. Always a pleasure speaking to you. It's fantastic conversation. Catch the whole conversation with Neeraj on the panel on YouTube. Stay tuned to NDTV Profit.